This is Dan Osmond from UK Moneyman, here to talk about various ways in which you can reduce the amount of mortgage that you've got in retirement. A lot of people feel that, particularly if they've taken out something like a lifetime mortgage, which is a form of equity release, that they can't make any lump sum payments to the mortgage over time. Now, with most lifetime mortgages and most retirement interest-only mortgages, plans like that, you can pay up to 10% of the loan amount each year with no penalty. Now, with an interest-only mortgage, that will be over and above your interest payments. With the majority of lifetime mortgages, that will include the interest that you owe over the course of a year. There are exceptions to that where you can pay the interest and pay an extra amount, but it's a small amount of the products out there, but your advisor will go through that with you. Now, if you want to pay off more, then depending on the sort of mortgage you have, just like when you were younger and taking out a 5-year fixed rate from Halifax to buy your next house, there are potentially penalties for making large lump sum overpayments. Okay, now one of the ways that you can deal with this is to, when you're taking out your mortgage, if you disclose to your advisor that yes, I'm expecting an inheritance, or I'm expecting money coming from an investment, or wherever it's coming from in the future, what they can do is they can try to tailor the product so that the impact of any penalties is going to be minimised. You can't always avoid them, and it's going to be up to you whether you make that large lump sum overpayment and accept some penalties, or whether you spread the payment over a number of years so that you avoid the penalties. But I think it's a question of looking at how much the penalty is, how much the interest rate you're paying is, what it would save you over time. So yes, you can make lump sum payments. Whether it's a good idea, whether it's can be allowed for before it happens, all of those things are very, very individual to your particular case. Talk them through with your advisor. Look at all the mortgage options. It may be that if your ultimate idea is to take a lifetime mortgage, but you're expecting a lump sum payment in a couple of years, it might be better that an advisor looks at say a 2-year fixed rate for you now, with the idea of moving on to a lifetime mortgage after you've reduced the balance down. It would certainly have a beneficial effect on your interest rates and the amount of interest that would accrue over time. So talk it all through with your advisor. They'll come up with a solution that best fits your circumstances.